Hi everyone, how's everybody doing this afternoon?
Good.
Good, excellent. So hopefully you're getting some great and valuable information here this afternoon to help you grow your portfolios. This is our first time at the Investor Forum Conference, so we're excited to be here. So we're going to briefly tell you a little bit about ourselves before we get started. My name is Amanda Crowther, and along with my partner, we are the managing partners of Simple Acquisitions. And we are a syndication company. So we purchase cash-flowing properties in strong performing markets in the United States and in Canada, and we partner with investors to provide them an equity share in those properties. I myself have about 20 years experience, 20 plus, in contracting, procurement, finance, and I manage multi-million-dollar project budgets. I caught the real estate investing bug about 9 years ago when I met my partner.
Hi everybody, my name is Mark Dupuis, and I got a bit of a mixed background. I worked over 20 years as a business analyst in the corporate world, and at the same time I was buying and building, renovating and flipping single family, some small multifamily and commercial properties. And now I'm doing real estate investor full time, so I'm living the dream.
So just to make sure
That was a joke, everybody. You're supposed to laugh. Come on. It says right here, laugh. Everybody laugh.
So we are neither accountants nor attorneys nor financial advisors. So we always encourage people to speak with their advisors to make sure that what they're planning on doing fits in with their investment strategy.
What we're going to share with you today is a bit of a strategy on how we buy real estate. And we want to start first by sharing how we see capital. So we all started with a bit of seed money. We worked hard to get that money, put it together, working long hours at the job, sacrificing, saving for months, maybe years, maybe even working those jobs that we really didn't even like. That's a part of our job, our life that we're never going to get back. So we see capital as life, and that's why we treat capital in its highest regard, whether it be our capital or our partner's capital.
Right, so with a show of hands, how many people here already have investment portfolio and are at the point now where maybe you're trying to grow that portfolio but having an increasingly more difficult time doing that, right? Maybe that you can't find good deals, right? It's really hard to find good deals in Toronto. Or perhaps you can't find the financing. Or maybe perhaps some of you have a sizable portfolio and want to grow it further, but you're spending all your free time on the existing portfolio. Or perhaps we have some newbies in the audience. So there's some new real estate investors out there, couple. So perhaps you don't even know if real estate investing is right for you, or perhaps know all the benefits that this asset class has to bring.
Well, if you can relate to any of these situations, we're going to share some concepts with you today that's going to give you a little bit of clarity, and it's going to give you a path in order to continue to buy. So we're all here for the same reason, right? We all want to grow those portfolios. And yet we already all know the formula, right? Buy low, sell high, right? Everybody knows that, right? Buy low, sell high. So if we already know, why are we here? We're sitting here on a Saturday afternoon when we could all be out there doing something way more fun, right? Well, hold on a second. This is fun for me.
This is fun.
So for me, or us, buying low is buying a fixer-upper for $400,000. Right? And we're having bidding wars for those fixer-uppers. Toronto here, it's even worse. So, so even if you're in a market where you still can buy things low, that's not going to last forever. So you need to find a way to continue to buy once those markets change. Right?
So we're going to talk about some key real estate concepts, and then we're going to bring it all together into a strategy that we can all use to grow our portfolios more. Is that okay with everybody? Yes or yes? Awesome.
Concept number one, you want to keep as much of your investing capital in play as possible. Real estate has created a lot of wealth for a lot of people that know how to use it. One of the benefits has more benefits than any other asset class out there. And just one of those benefits is allow you to do just that. Keep as much of your investment capital in play as possible.
So that's interesting, Mark. How do we do that?
Well, what's one of the biggest strains on our capital every year? Anybody?
Oops.
Taxes, right? We pay too much bleeping taxes. What if you could keep more of that money, the money that you normally would pay in taxes, in play? You could build a bigger portfolio faster, couldn't you? One of the most underutilized concepts that I see, even in seasoned investors, they don't depreciate their assets to shelter the income from the taxes. This concept is not complicated. It's right in the tax code. All your accountant has to do is do the right things and apply those deductions to your property. So keep as much as your investing capital in play as possible.
So I'm sure many of you already know here today, or perhaps finding out here today, that there's many, many ways to invest in real estate. You can be a landlord, a wholesaler, a flipper, a buy and holder, a lender, developer, and the list goes on and on. And Mark mentioned earlier that real estate offers more benefits than any other asset class out there. However, you really need to be on the ownership side of that to take advantage of all those benefits. Sorry, wholesalers.
There are other good ways to invest in real estate. For instance, let's talk about second mortgages. They're great, right? Hands-free, which is everybody wants. Get some good returns, but you can't depreciate that income from taxes. So that's something that you really want to think about when you decide on what to invest in. I understand we all get into real estate for different reasons. We all have different cash flow needs. But if you want to get the biggest bang out of real estate, you really have to be the owner. So you need to be on the ownership side of the equation.
Okay. So Mark talked earlier about buying low and selling high. So what makes anything go up in value? Supply and demand, right? So let me give you an example. With a show of hands, how many people here right now in this room would like to buy some air from me? Anybody? Why not? Right, there's an unlimited supply and it's free, right? But if I dragged you by the arm and pulled you 50 feet underwater and held you there for a long period of time, now how many would like to buy some air? Probably all of you, right? I hope so. And I could probably charge you whatever I wanted for that air, couldn't I? So what changed? The supply, right? Markets that are the recipients of, sorry, missed my line on that one. Ha. Right, sorry, my apologies. Oh yeah, right. So with respect to real estate, what is the key driver that influences the state of supply? Jobs, right? Markets that are the recipients of increased job growth see tremendous job growth. I'm going to give you a couple of examples. They're a little bit older, but they still clearly show you how the economy impacts markets. In the 1990s, Sun Microsystems brought 20,000 jobs to the Phoenix, Arizona area. And as a result, that market appreciated by 42%. Between 2005 and 2008, in the Texas Metroplex, which is the Dallas, Fort Worth, Houston, San Antonio area, they brought in 120,000 jobs, and that market appreciated by 46%.
How many are aware that Ottawa is experiencing an incredible surge of real estate right now? Yeah, a couple of you? Would it surprise you if I told you that that market has appreciated 6% over the last 5 years? Expected to increase another 3% over the next 3 years. Why? Jobs. How many here are aware that driverless car technology is being developed in Ottawa? Ford, 500 new jobs in Ottawa. QNX, another company that's in the driverless car technology, 500 new jobs in Ottawa. And there's a lot of other high-tech jobs that are in and around that area that are supporting that whole driverless technology. How many here are familiar with Shopify? Yeah. 3,000 new jobs in Ottawa over the next 5 years for Shopify. There are other companies that are bringing in other jobs as well. And as they continue to bring jobs, that's going to continue to push upwards pressure on that real estate demand.
All right. So jobs create interest in a market. When jobs are first announced, local investors start buying. And as those jobs get filled, people coming into the market, right, the vacancy rate starts to drop. New construction from the oversupply of the previous cycle starts to get gobbled up and prices start to climb. So as investors, when you get in early in an emerging market, several things happen. One, there's initially less competition. You can get higher than average returns, and you can trade up faster as things start to heat up.
So to have your portfolio see steady growth, You want to find those emerging markets and use the appropriate strategy based on where they are in the cycle. Once you know what the 4 cycles are, you're going to be able to have a better grasp of what's going on and why. And more importantly, you're going to know what to do in each one of those cycles.
Right. So that sounds like a lot of work and a lot of things to keep track of. Are you suggesting that I should buy in places other than where I live?
Absolutely. If you want to see your portfolio have steady growth, make things easier on yourself, you're going to want to ride the waves of those emerging markets.
Okay, so then how do we keep up with what's going on in different markets, right? So the best way to take advantage of emerging markets and to leverage everything we do in real estate is to use professionals, right? We all call them our power team, right? The brokers, the property managers, that sort of thing. So they're the experts in their chosen field in the markets that we want to do business in. So they are worth their weight in gold. So we use these professionals to guide us towards finding the proper property in the right neighborhood and to ensure that we're buying the right asset.
We personally use a company that doesn't have just the advisory services, but they also have a brokerage side to their business. And we often see those brokers out in the marketplace when we're buying properties. These professionals make it a point to be on top of the markets, not just the real estate markets, financial markets, the real estate market. They see where the smart money's moving, they see what markets are moving, and they can help you buy when things start to change. They even get involved in things that affect real estate. Like earlier this year when we had some tax changes in the US, they put together a webinar with some of the top national experts. They went through all the changes so that people can see how is this affecting me? They went through all those changes for everybody who owns real estate.
So when you have those type of services and that knowledge, then you can start drilling down into the markets that are emerging. And usually there's multiple markets emerging at the same time, in the same period in the cycle. So you can kind of choose the ones you like. We choose markets that we can drive to in a day, albeit a long day sometimes at 14 or 16 hours, but a day nonetheless. And we like markets that are good climates for obvious reasons.
Once you've identified your market, now it's time to get in there and find those boots on the ground type of people. We find that the #1 person that you want to get involved with is the property manager. They make it we go down there and we'll meet with them, make sure that we kind of interview them so we know which ones that we kind of like to work with better. So you want to go down, find those pros and use them.
So the world we live in it's crazy fast. Things are happening faster than ever, and there's always things that are intriguing and things to distract us. So when it comes to investing, you need to have your head on straight and have a plan.
Your plan, or lack thereof, it's going to affect everything you do, from what you tell your brokers, what type of assets you look for, to what type of financing is available for your deals, to whether those professionals even want to deal with you.
And it's not enough to just have a plan. You need to write it down and execute it. So if you reach your initial goals, you re-baseline and you set new goals.
So having a plan, then doing some research, it's going to help you determine what type of real estate is right for you. Knowing the type of returns that are customary for the type of real estate that you're doing is going to help you speak more intelligently to your brokers, to the bankers, your fellow real estate investors, and really anybody who's in the business. And it's going to lead you to have more credibility. It's going to lead you to do more deals. And more importantly, it's going to lead you to do more deals that really fit your investing criteria.
And you want your power team to also have a plan, right? So your broker, for instance, you want to make sure that he or she has a plan to source you good properties, especially when the market starts to get tight. So they need to have a plan, and they need to execute it to meet your objectives.
We do things backwards. We go see the financing people first, see how they underwrite stuff. So we only bring them deals that meets their criteria. There's all kinds of metrics out there. Most lenders will tell you exactly what it's going to take to get a deal done. Our institutional lenders, for instance, they want to see our debt service at about 1.2. And they want to see our net worth equal or more than the loan amount that we want. So if you want to borrow $1 million, you better be worth $1 million or have somebody on your team who does.
That's right. And then there's liquidity. This one's a bit more subjective, but typically deals that are similar have similar formulas. So for example, a cash flowing property that has minor deferred maintenance. The banks are going to want to see just a couple months worth of debt service in your bank account. So once you know those type of thresholds, you can incorporate that into your buying criteria so you know what your lenders are looking for.
Okay, so finally it's time to put this all together in a strategy. Obviously one that incorporates some of those concepts that we've just been talking about. Now, we don't want you to think that those are the only things that you have to think about when you're thinking about these kind of deals, but given the time frame that we have, that's about as much detail as we can go into.
And so if you haven't figured out by now, the strategy we're going to talk about is syndication. And it's simply an effective way to pool financial and intellectual resources together to purchase a property larger than most individual investors could afford or manage on their own.
Pretty simple, right? I'm sure some of you may even have used this kind of strategy in the past to buy stuff. It's pretty simple, but it can have some legal implications. Let's say that myself and a couple of you fellows here in the audience are going to do a deal together. What most financial institutions are going to have us do is they're going to have us create a corporation that's going to hold that property, right? So on the day of closing, what are we going to get? We're going to get 25% ownership in that corporation, right?
Right. So in reality, we aren't really buying real estate, we're buying shares in a company. And for that reason, the security regulators get involved. And we make sure that we engage the OSC if we're here in Ontario, or the Securities Exchange Commission, which is the federal body in the US, to ensure that we raise capital properly.
So let's look at a typical syndicated deal. So you all get an idea of what's all involved. First, the syndicator is going to find that market. Then they're going to go into that market, start finding those boots on the ground type of people that they need to put the deals together. Your real estate brokers, your mortgage brokers, your appraisers, your securities attorneys, your real estate attorneys.
Right. And then with the help of the power team, they're going to look for properties that meet the buying criteria. And there's lots of different approaches out there. You can buy a portfolio of single-family homes, a multifamily complex, warehouse, office, medical, or even storage units.
Once they find that property that they like, they get it under contract, they'll then circulate that property to all their investors who bring the equity to make that deal happen. Again, there are so many ways, so many different business models out there. So if this is a type of strategy that you like, you want to make sure that you take a really good hard look at the syndicator that you're dealing with to make sure that they have the same type of strategy that you have. And of course, that incorporates some of those concepts that we talked about earlier that are so important for you to have as an investor.
So we'll talk about our business model. So you have an idea of what syndicators like us look for and the buying criteria that we use to choose our properties. For the most part, we are buy and hold investors. So we're going to hold properties for several years. Because of that, we want to make sure we work with people that we like and get along with. Makes sense, right? So there's a saying from Warren Buffett that says you can't do a good deal with a bad person. So we make sure that the people that we partner with are of good character, have the highest morals and equity. Equity is good too. What's the word I'm looking for? Morals and ethics. Sorry, ethics, equity. Yeah, to ensure that they're working with the people that are of that good nature.
So the first concept we spoke about earlier was to keep as much capital in play as possible. Our motto is to bring value. So we look for underperforming properties that we can increase the cash flow from, which in essence increases its value. We do this for two different reasons. First, it's a good feeling to bring that piece of asset up to its full potential. But secondly, and most importantly, if we can bring that asset's value up enough and refinance it and get all our investors their money back in their pockets and they're still participating in this cash flowing deal, right? Now we're starting to get into some infinite returns on investing, right? Now we're starting to get into some stuff that's exciting, right? Yes or yes? Yeah.
Right.
You guys are falling asleep out there.
So this allows the partners to participate in future deals, hopefully with us, but in other deals. And in order to do this, we need to look to find different ways to bring value to properties. So we always look for those underperforming properties and try to inject at least a few value play activities in there. And we always identify our exit strategy before we buy.
So there are so many ways to structure deals. We believe that since our partners are shouldering some of the risk with us, they should share in the profits. So investors who partner in our deals get a preferred share in the investment. They're really part of the ownership group, which is really important when you think about all the benefits that you get from real estate. This means that investors who participate in our deals get more than just a fixed rate of return.
Right. So now we're going to talk about some market and property criteria. So we prefer to get into markets where the occupancy rate is at least 87%, and that's for a couple reasons. The value is still low, which allows us to get upside from that, and also it's for financing purposes. The banks are conservative, so they're going to give their preferred rate to properties that are stabilized, which is, greater than 85% occupancy for at least 3 months.
The markets that we like to invest in have a population of a minimum of 500,000 people. They also have economic and population growth of a minimum of 2% last year, this year, and are expected to again next year. We also like to see a minimum of 5 Fortune 500 head offices in different sectors in that market. And we like to see a lot of affordable single-family houses in that same market.
And for property criteria, we like to look for a minimum of 50 units. And that's to get the economies of scale and also allows us to have a full-time property management on staff, which really helps us manage things better. They're also looking for the worst building on the best block. So that ugly duckling, so to speak, so we can inject those value play activities and get the returns up.
In order to satisfy our institutional lenders, we look for properties that have a debt service ratio of 1.25 to 1.3. And we look for a cash-on-cash return of 12%. And that's before we start making any changes. And those numbers are starting to come down a little bit now with prices increasing and everybody's expectation of returns kind of coming down a little bit.
And I should also mention that we also look for loans that are a minimum of $1 million. And the reason for that is we can get non-recourse loans, which is lower risk for everybody.
We strongly believe in the in the benefits that real estate investing has. So we want to make sure that those who participate in our deals with us are afforded all those benefits. So our partners share in the cash flow, they share in the appreciation, they share in the depreciation, and they also share in the potential of deferring capital gains.
Right, so if you're looking for a strategy that brings into these criteria into play, then maybe syndication is an avenue you'd like to explore to help grow your portfolio more. There's lots of syndicators out there, so make sure you do your homework. A smart investor is a knowledgeable investor.
Amanda and I want to thank you guys all for coming out and hearing us talk today. If you guys would like to speak to us any more about real estate syndications, we've got a booth over here at number 3. You can even come over and have a chance to win a Google Home Mini. Thanks, everybody.
Thank you very much, everybody.